my pleasure to be here. It is the first time that we are presenting this research with Rob Engel. This is part of an effort that S&P Global is undertaking to have alternative views of credit risk in the market, in addition to our traditional ratings and also to our efforts in this space. So we are partnered up with the V-Lab Institute, with Rob Engel particularly, but also we have been working for many years with Professor Edward Altman, is one of the organizers and also friends, and Ed has been advising us for many years on issues obviously around credit risk and statistical analysis, so, which is an important partnership. This piece is interesting from different perspectives, particularly because we're using SRISK, a very popular measure of systemic risk, econometrically speaking, in the academic circles, but also in the practitioner world, is getting traction, developed by Rob Engel. There is nothing to say on Rob. Is a Nobel Prize for Economics in 2003, Oliviero? Not 2002. I don't know if he won 2 times, but I think only once. And he essentially, in this systemic risk measure, which is called SRISK, there is all the research that Rob has developed over decades. So ARCH, GARCH, varying parameters of risk, which is essentially how risk changes over time, how risk adjusts according to the evolution of financial markets. And what we did, we took this popular measure and we applied, this is a case study, on 3 main stress events, largely unexpected, that occurred in 2016. We defined this, so these are the very famous Brexit, the Trump election, and the Italian referendum. These are very important because these are geopolitical events with important effects on financial markets. We define these events collectively as BRAMPIT, so we define this new acronym. As you know, English speakers tend to like the use of acronyms, so let's get started, used to it. So the BRAMPIT here, and we'll see what we did here. Essentially, systemic risk, because of the interconnection in the financial markets, it's a new irrelevant risk dimension. Everybody knows about individual risk of company. Ed Altman started developing this in '68, and many others followed. The Basel requirements tend to have similar measures, but systemic risk has been, I would say, a recent dimension due to the global interconnectedness in the financial markets. And this measure does what also the regulators do. The Basel Committee, the Fed, the European Central Bank, everybody looks at it. They also introduce capital requirements based on systemic risk for large and systemically important financial institutions. And SRISK essentially is a complementary measures or a complementary view that provides additional information. It's not a substitute to it. It's not a replacement. It's a complement. So it can be used as an additional, a useful tool to capital requirements, to external ratings, and to other measures of riskiness of companies. Our, obviously, definition, many of you here, you are academics, know this measure, but essentially it is a stress test in the sense this is a market-based view of stress test. It is the capital shortfalls, the capital amount of capital needed by an institution when there is a market-wide stress test. And Rob Engel and his colleagues at the V-Lab, including Viral Acharya, currently Deputy Governor of the Reserve Bank of India, Matt Richardson, and many others, have obviously contributed to developing this measure. They use in market data, very simply speaking, equity returns, publicly available data you can also find on Google Finance or wherever you want. They analyze, estimate econometrically the bivariate time series on a daily basis between equity return on a firm and the return on a market index. In this case, they're using a competitor index, MSCI Global Index, but you can also use S&P, whatever. It's similar. And then these co-movements between the equity return on a company and the return of an index gives you an idea of the systemic risk effect of the co-movement. And I'll explain why and in which sense this is a stress test. And the stress test is related to the fact that there should be a market-wide stress due to a fall of the market index, in this case MSCI, of 40% over the next 6 months. So when there is a 60% decrease of an global equity return over the next 6 months, which is compatible with recent performances under the crisis of the Great Depression, 2007-2009, the measure looks at the impact on the equity capital market base of the company. So very simple and also very appealing. Why I said it is a complementary measure, this is not a replacement, because regulators obviously have their own regulatory-based view of systemic risk based on balance sheet data. Is by definition a backward-looking and static view. They look at the balance sheets, at certain characteristics, and in this particular case, banks and insurance companies are considered to be systemically important because of their size, risk profile, interconnectedness. And the regulators define static parameters, and based on specific weightings, there is an additional capital requirement called the systemic risk surcharge in order to take into account also of this systemic risk dimension. The larger and the more interconnected companies are going to pay more and lower the others. These are the criteria that are updated regularly. This is the initial proposal was issued in July 2013, but very recently there was another update in March 2017. The regulators update their view and make obviously all the changes, and they work together, the Basel Committee, which is obviously the institution that proposes these rules. They work together with the Financial Stability Board on the bank, and together also with the National Association of Insurance Company, International Associations, and there is obviously an involvement also of the industry in this case. So this is the base, and this is where capital requirements is tangible for institutions because they will have to pay starting from 2018, and this approach will be phased over the next years. And this SRISK is again a complement, market-based. You need equity data, so it's very appealing, very simple. There are also obviously some limitations because of the use of equity markets, the fact that SRISK can only be measured for listed companies. This is another important point, and I will tell you more what we are doing on this front with S&P Global Market Intelligence and the VLab Institute. But it is a very powerful tool that gives you not only indications on the direction of risk, but also on the magnitude. And the magnitude is also very important. So what is the capital amount, the shortfalls, in case of a stress in the market that institutions will need to have to avoid systemic risk impact, which means bank runs. So that's essentially the point of the measure of SRISK, is having a certain amount of capital that would avoid bank runs or runs in general, because not only banks are involved here. Every day there are updates on the VLab website. Every week, every weekend, the people, the scholars working there update also the econometric estimation on the Bavaria Daily Time series. So everything is there, everything is transparent, and it is also freely accessible to everybody. You can go there and understand what happens to the situation of systemic risk in the world. Simply speaking, I don't want to spend much time on it. There have been many papers by Rob Engel and and his colleagues, very sophisticated. Again, SRISK is based on the research of Rob Engel over the years on the estimation, econometric estimation of risk parameters that changes over time. So this is again, everything is behind this measure. So what you need to know, there is a capital threshold, K, could be 8%, 5%, based on the capital requirements in different regions. The user can also change this value. You need to know the market value of the equity, the leverage, so which is the accounting debt, and also the key variable, which is the acronym is LRMES, long run marginal expected shortfall, which is the variable that quantifies the bivariate relation of the time series of the daily return on a firm versus the return on a stock market. This is non-linear, is not symmetric, it requires simulation, because there is obviously a generation of volatilities on the returns and the correlation between return and the index. These values are simulated many times over the next 6 months, and whenever the global market index falls by 40%, the capital shortfall, the equity market value shortfall is recorded. That's the design of this very powerful measure. So the long-run marginal expected shortfall is where the beta and all the parameters, volatility, are time varying, so the changes over time based on the initial idea of Rob Engel. And here an example you can easily find if you have the value, the equity value, the leverage, the capital threshold, the long-run marginal expected shortfall needs to be estimated. You can easily find what is the equivalent capital need for that specific company in case of a 40% decline of the market index. What is important that SRISK obviously is a systemic risk measure. Individually, it gives you an idea of the capital shortfall, but in aggregate, it is where the meaningful result appears, because it's aggregating the SRISK capital shortfall that one gets a view of the systemic risk globally or in a specific region. So it's the aggregate value that matters. So there have been lots of critiques on this measure because it captures the co-movement between the return and on a firm and the return of a market index, but not the interconnectedness. But however, this measure, since it's based on a global decrease stress test of 40% decline, so it also implicitly captures an implicit interconnectedness in the market when the aggregate capital is low. Here it becomes, I think, the interesting story. So what happens when we look at the values before and after these events? And this is what, anyway, we discussed a lot. We had lots of discussion, shared lots of views with Rob Engel and his colleagues. We initially started many months ago with a focus on Brexit. Then it was largely unexpected. Then there was also the Trump election. We said, let's wait for the Trump election before writing out the paper. Then let's see, there's also Italian referendum. Let's write up after the Italian referendum. Then we say stop because there was also the French election, otherwise the paper will never be out. And we say, okay, we have now, let's focus on 2016 and trying to understand what happens and what happened particularly to the system and what are the effects on systemic risk. So BRAMPIT is the acronym for these three events. And why these are important? Because despite the fact that BRAMPIT appears to be a global story, all these Brexit, Trump, Italian referendum, French elections, local elections yesterday in Italy, and whatever happens, they are all related, all interconnected. We are in a global market. Whatever happens in France, in the UK, has an impact on Europe, on Italy, in other many countries. So it's very important. 10 years ago, the situation was very different. The economies, the financial markets were exclusively domestically. I remember when we had lots of discussion with Michael Gordy from the Fed here, I don't know, 10 years ago, 15 years ago. We are very old now. in Italy, it was a very domestic country, and all the countries were completely independent of each other. Now the systemic interconnectedness is super relevant. Brexit, for example, impact on British company, from British, US, European. There was a peak 1 month after the event. It was largely unexpected, and obviously this was a big threat at the time. Also now for the European Union, there's the breakup of the Union, and all these kind of considerations. So between the date of June 23 and after 1 month, there was a still material impact on companies. So all firms in financial companies in the world increased their systemic risk. But then the prompt intervention, I would say, of regulators, the Fed, the Bank of England, the European Central Bank, they injected liquidity, and they took also different actions. The situation definitely changed positively, and institutions show a significant resilience. This is also due not only to the prompt intervention of the central banks with the liquidity injection, but also because over time, the regulators have built a very strong and safe regulatory system. So the Basel Accord, of which, again, Michael Gordy was one of the architects behind those formulas, creates the condition for a very safe financial market. That's why the resilience of institutions to this very unexpected event. However, as we said, this is only a short-time effect. As you know, we had also the general election on June the 8th in the UK. The situation, the Brexit is not over. The effect is not clear. And it takes time for these events to play out. So let's see what happens. The uncertainty remains, and SRISK will become even more relevant to monitor in real time the evolution of the situation. Just a couple of comments on the Brexit, particularly in the paper. You can also find more details, and there was a specific effect, negative effect on some UK banks, particularly Lloyds, which is heavily exposed to the UK economy. Much smaller was the effect on, for example, HSBC, which is much more international, so much more diversified. These are some of the things that we found, but in general, the effect was quite positive. On the Trump election, the Donald Trump was, again, very largely unexpected. We were in London at that time, just the morning before the result, with Ed Altman and other people at an event in London that we organized on SRISK. Also, Andres, my colleague, was there, and another very unexpected. Donald Trump took over the country, and then what could be the effect again of this event? Short term, over a few days, what we noticed that the result was largely unexpected, but more positive. All banks, particularly and insurance companies, reacted positively. Why? Simply in terms of market cap improved. In some cases, like JP Morgan, increased significantly. Why? Because the Trump announcements were very positive, and then the expectations around his announcements were very well taken by banks, particularly by institutions, because he wants to deregulate, he wants to decrease taxes, and obviously the likely beneficiaries will be large institutions. So this is pro-financial institutions, and the reaction was positive. However, when we look at the changes, particularly over the one month period between end of October, end of November, and we look at the change in SRISK, so who were the institutions that reported a higher level of SRISK, and this is the column highlighted there, you can see the top companies that reacted more negatively were Latin American banks. Again, the majority of these 10 large banks, 5 were from Brazil, one of the most troubled country. Sorry, Oliviero, for that, but that's unfortunately not a good news for you. And why? Because again, the announcements of Trump on Latin American countries were not so positive. So trade relationships, the walls, and similar negative effects that could also contribute negatively to an already negative economic situation in particular countries, in particular in Brazil. Again, these are very short effects. Most of these effects are quantitative effects. We are not saying these are long-lasting, but just what happened, and I think it is very relevant. When we analyze the data, we were both surprised, also Rob Engel, to see that the Trump's election was maybe a non-event or positive, slightly positive for American institution, but for Latin American, the situation was a different story. This is, I think, is a good point. And I don't know if you want to say something, Olivier, on Brazil, but there is little to say, I think.
Yeah, I guess that situation that was joined with a very, very difficult political situation, a sort of money pulite going on. It's called Lava Jato. You probably heard about the problem that the top politicians are facing now in Brazil. So coupling probably the two things, the change in the Trump administration for the trading with Brazil. U.S. represent the main counterpart for trading, and the political instability due to this Lava Jato problem probably is one of the reasons why the 50% of the sample is Brazilian.
As you can see, if you look at the table, SRISK, before the event, which is denoted as T-1, was negative for the first two banks, Banco Bradesco, Itaú, Unibanco, which means they were not exposed to systemic risk before the event. After that, they were not only exposed positive values, but the capital shortfall was enormous, $10 billion, 10.5 and $8 billion for small with bank, very small capitalization, which means a very strong run. And on the right side, you can see that the effect, you can also decompose the effect of SRISK in the contribution of debt, accounting debt, equity, market capitalization, and risk. You can see that equity and risk increase significantly. So here, an increase in equity means an increase in systemic risk. So the positive value is not positive economically, and risk as well increase specifically. So volatility and correlation of the return of the company. I think this was an interesting result. Obviously, that changes over time. Now the situation is different. These companies are, apart from Banco Bradesco, the others are less risky, but still denotes an important aspect of the situation. And here we are with the Italian referendum, which is obviously more important for this market, but not only, because Italy is the largest country in Europe, and together with France and Germany decides the fate of the European Union, of the future of the European Union. And what we noticed that at that time, so there were lots of, obviously, it was also largely unexpected. At that time, a prime minister from this city was trying to reform this country and started an interesting program. Unfortunately, Italy is not an easy country to manage. And this referendum was negative for the current government. The prime minister resigned, and then we wanted to obviously analyze what was the impact, right? If a prime minister at the time was trying to reform the country, was pro-Europe, so the risk was at the time that the populist and the anti-European views of some groups in Italy could have prevailed and then interfere in a creation of a safer and solid European Union. So this is extremely important. However, the effect, the impact on SRISK measure has been very limited. So we analyzed the window between the end of November and end of December, and also the current situation. And essentially, apart from a situation of another local institution, not from Florence, from Siena, which was for Firenze, the Monte dei Paschi, which obviously was under a very specific, I would say, idiosyncratic situation of default risk, so nothing to do with systemic risk. The other banks reacted quite well, so there was no particular increase, and the opposite, the majority of them decreased. The systemic risk exposure, Intesa, Unicredit, and the others. So excluding then the effect of Monte dei Paschi, which, as you can see from here, reports some very high level of risk, particularly leverage, for reasons that we know, which has nothing to do with, I would say, nothing to do with systemic risk, but has to do with pure default, interaction between default, I would say, and political risk. Being an Italian, I've been following the situation, and I was also a managing director of large banking groups in Italy, and I know very well what happened in the case. But the most important point from this analysis was the result was largely unexpected, but didn't have an impact. So, which was positive, resilient, I think, because the problems in Italy are more than what we can see. So we know that it's difficult, again, to find agreements. It is not a very united country. So there are structural issues here that I think they are going to be addressed. But the most striking result was, from a magnitude point of view, that the capital shortfall of Monte dei Paschi was exactly in line with the amount estimated and requested by the European Central Bank. There has been a discussion between the government and the European Central Banks. They said the bank needed 6 billion euro, and the ECB in December came back with an additional request of 8.8 billion euros. And there were rumors about where this number came from. We found, surprisingly, that the Rob Engel's measures are very much in line. So his capital shortfall for Monte dei Paschi was $9 billion that at exchange rate at the time was 8.7 whatever, which is 8.6 against 8.8. So the European Central Bank looks at what Rob Engel does, and is likely, since Mario Draghi was one of his students at the MIT, that could be also a potential explanation. But it is good just to show you that this measure and the magnitude of this powerful tool estimated the amount of capital required to be very much in line with the one requested by the European Central Bank. And it's very conservative. The stress test, I think, is a very important one. There is I have some final remark, but in the last 10 minutes, we also would like to give you a couple of comments also on what's happening right now. So we are still working to update our analysis. We also carried out an analysis on the French elections. However, we are going to wait the second round of the legislative elections that will take place on June the 18th. But obviously, the result of yesterday's first round was super positive. So Macron appears to have a majority in the parliament, which is again a very pro-European Union result that, coupled with what I read this morning when I was having breakfast on the local Italian elections, since again the populist groups appear to have lost lots of traction, there is also a convergence of stances versus a support of a much stronger and a much better governance of the European Union, with also the position of Merkel, which is apparently going to win also the other elections. So these are things are evolve very rapidly. Situation change day by day, and we are going to come up with an additional analysis on the French election on the 18th. But it seems to be that the European Union, at least the concept, is becoming stronger. And also, let's see how Macron, Merkel, and the new obviously governance in Italy, elections or whatever, what will happen. But it appears that there is, in a way, slow, and obviously slower than expected. But this is not a surprise. It's not an easy situation in terms of governance, political governance. This is much more difficult to manage than measuring econometrically the capital shortfalls. But these situations have a strong impact on this issue. Another important takeaway from this analysis is, first of all, not only banks are at risk of being systemically important, insurance as well, and they are regularly in the list of SRISK, and also obviously as mentioned, as proposed by the Financial Stability Board, by the regulators, they are there. They are not very happy to be there. So we talk every single day with the chief risk officer of insurance company, particularly in Europe, in the United States. At the moment, we are having a very intense conversation, particularly with US insurance companies, Willow Bengal and I, because they want to convince us of the different natures and characteristics of insurance companies to try to come up with an adjusted measure. There are specific differences between banks and insurance companies. And also the complication, this is also where SRISK has some limitation by default, is that the regulation has also an impact on this measure because the rules in the United States for insurance are different than the rules of Solvency II in Europe that are more market-based. And then we are trying to understand together with these chief risk officers of the large companies, and particularly the ones listed there, Prudential, Hartford, MetLife, and these guys, to try to adjust this measure to take into account in a more proper way these differences. Another takeaway is that not only banks, but also insurance companies, but also asset managers can be at risk of systemic disruptions. Why? Because there is also a current economic situation which is not positive, low interest rate, trying to increase return with a very difficult moment. Active asset management is at risk versus passive. So they're trying to be creative and then more having much riskier approaches. And then asset managers in many cases, also particularly in Europe, they are part of large banking groups. So in the US it's a little bit different, but in Europe, in Italy, all the largest asset managers are part of banks. Horizon and many others. In Europe, in France as well, is very similar. And then there is also another interconnection. So if banks are at a systemic risk, also asset managers can be as well. The impact we didn't want to obviously come up with a definitive answer on it. It takes time to play out. Mario Draghi continuously reaffirms this concept. So we don't know what's going to happen. The UK election, general election of June the 8th, a few days ago, is definitely more positive for Europe than for the UK, because it complicates more their negotiation than ours. I would say, when I say ours, I live in London, and then I'm between the two. But I think in a way the UK is a strong country, resilient, but at the same time, this lack of agreement is going to complicate definitely the situation for them. So positive news for Europe and less for the UK. I think that despite all the limitation this SRISK measure can have, and on behalf of Bengal, we have discussed many times, as a researcher is very open to criticism and he wants to improve. So it's amazing how a person so successful, so mature professionally wants to improve and adjust his measure. So is the guy going to call me every day? Let's talk with his chief risk officer. Let's try to change, make some advances. So he has two ideas now, and that I've been discussing with him. But he wants to make two adjustments. First of all, an adjustment to SRISK for insurance companies, particularly to address the divergence between US insurance company and European insurance company from a regulatory standpoint, Solvency II market-based and statutory accounting-based in the United States. And we're also working with a person on the Fed, Tom Sullivan, whom you know, Mark, for sure. And the second enhancement he wants to make, together with us, we have lots of data available in our company, is to enhance SRISK to take into account also the systemic risk dimension of private companies. So we want to extend the model, not to include only listed companies, but also private companies, via an accounting-based proxies using data from fundamentals of financial balance sheet and profit and loss. We are providing this data to the VLab, SAP Global, and we are gonna come up with these two enhancements that I think are very relevant in order to assess also, or to have a proxy at least of systemic risk dimensions in companies that are not listed. There are some large institutions that are not listed, and this measure doesn't capture those, and is aware, and we are more than happy to help Rob, Viral, Acharya, Matt Richardson to enhance this measure. And also for the insurance company, we are much more than open. We had 2 minutes, but particularly last week, I was in New York and I presented at Risk America's 2017 on a different topic, but we have been approached by a couple of large chief risk officers, and they were furious by the fact that their names were in the list. They are furious that their names are in the list of the regulators because they said that neither the regulators nor Rob Engel have a good understanding of insurance company. So which is a good criticism to take. And then just to show you how Rob Engel is open, I just called him up the day after in New York, and next week we're going to meet the chief risk officer of 2 of the largest systemically important institutions in New York to discuss this issue. So I think it's a good, in a way, interaction between the academic world and the practitioners, and obviously we as a company are a perfect interlocutor. We are also have a vested interest in trying to increase the awareness in these large companies that are also rated by us. So these companies are rated by our rating divisions, and now they see that we also have a view on the market side of the story, and we want to make sure that they have a clear understanding. So we are going to facilitate this discussion as interlocutors and also triangulating the market and also the regulators with members of the Fed and Rob Engel and his esteemed colleagues. And I think this is one of the main takeaways. This is not only research, it goes beyond that. And I think in a way, Rob Engel and team have a great approach. It's a pleasure to work with them, not only because they are super bright minds, but also because they're very open. They listen a lot. So when you have a discussion with them, is most of the time they listen and they talk, and I think this is very relevant. When you work with practitioners, they talk more than they listen, and it's a good combination to find a middle ground, as the English say, in this discussion. So thanks for your attention.
Thank you, Cristiano, because what you said, your last few sentences are really one of the aim of this conference, to bring together practitioners and scholars on risk in general, in this case on systemic risk. I can quote also that at Getúlio Vargas we are starting in Brazil. You know that I have 2 hats. Sometime I'm here. I spent 1 semester here, 1 semester in São Paulo at the Fundação Getúlio Vargas. We have one of our colleagues here. We started a new research group on something with a little different approach, but looking at how sensitive are the corporation to sovereign risk, especially in Latin American country where the sovereign risk is very volatile. So and we do it not on financial corporation, but on non-financial corporation, because it's relevant to know how the corporation, they do react to governmental upheaval that most of them, they are generated by systemic risk spread from other countries. I think we have 15 minutes to take few question on Linda. I was intrigued by the fact that what you were saying, that especially after the crisis in 2008-2009, there was a changing in the sign between the relationship between lending and equity, and that from negative that normally should be, it became positive, where the banks try to sustain the performance of the clients. I guess that your paper. It's really a long paper to be built due to a lot of the data. And I was mentioning to her that don't complain too much, because my aunt, she works for a restoration team here in Florence, and if you go to Santa Maria Novella Church, you will see the Jesus Christ from Giotto there, and she spent 12 years restoring just one painting. So I mean, I said, don't complain too much, Linda, even if it was difficult.
My work is nowhere as beautiful as that.
You will never reach the 12 year on the same painting.
I'm not delusional. Even though we think our equations are beautiful, they're not.
Visit it, because it's 2 years that the restoration was finished. It's absolutely wonderful. If you haven't seen it yet, it's nearby the train station.
Yes.
So one or two questions from the floor. Lorna, do you want to give the mic? And then Bill, I think. Short question, and then we switch to Cristiano as well.
Okay, just I like the endogeneity aspect of your...
Is off.
Well, the endogeneity aspect...
No, it's for the streaming. We have to be on. Oh, Ola, could you...
It's not working. Or...
It's a...
Sotto. Yeah. Try.
Try it again.
On.
The light's on.
Hola.
Bravo.
Hola.
Yes, yes, yes.
It's not just the bank's positions
Right.
in the firms, but the actual markets themselves are endogenous,
That's
right?
true.
And where the problems were during the crisis, was it really emerging markets, or was it Ireland and Portugal and Spain and these other countries? And just the extent of the problem, I mean, if we look at banks lending, right, the equity markets are fairly thin in these markets. So it's really the lending is going on to sovereigns that aren't going to be in your sample. There's no stocks for these companies. And lending is going to be coming on to companies in which you've got large government investments too. So you could say it's going to be safer assets.
Right.
So you're not necessarily getting a picture of the privates,
That's true. No
which
question.
might be getting even bigger spreads. And right, to show the spreads that are, are we going to make an extra 1.2 or 120 basis points? Is that what the extra? I mean, that's not necessarily such a big deal given the risk.
Oh, I don't know. I know people in the banking world that would sell their mothers for, certainly their mothers-in-law, for 120 basis points. So that's considerable. But something, no, just, I mean, in terms of just a quick answer to that, something that Cristiano said about the private firm model, using that, adapting that to a systemic risk, that's something that's really important, and I applaud that. That's great. So, but we don't have private firms in our sample.
The second question, you want to take the second question, then we ask the author to reply? Yeah. Wait for the mic, Bill.
And I reserve to have a longer question to the second speaker, because I have a very
You should say before.
good one I'd like to do.
Okay, you're allowed to do it.
I have
Bill
a simple-
Zimba, one of the founder of the conference, he's allowed to.
I have a simple one for Linda, piece of cake, which is, Linda, you did a wonderful job in the loans, and really have analyzed it well. Now, these firms also make recommendations of stocks. And I know that in some firms, I won't mention names, one with letters GS, they have one trader going long and one trader going short, and they know what's going on, et cetera. So we always think that there's insider trading there. So I don't know if you have any comment on that.
Right. No, I think that that's really important, because what you're suggesting is that they're, surprisingly enough, and I think Andy Winton was the first one who did anything about this, about the idea that these large global financial institutions could be managed centrally in some sort of way to optimize returns. And what you're suggesting is that all the activities that the bank engages in, whether or not that's analysts' recommendations or certainly mutual fund investing, asset management, M&A advising, as well as lending, all create this whole nexus of information, and how it's used within the firm is something that I would really love to get a great theoretical, doctoral student doing a theoretical dissertation to really model. This is something we haven't even touched the surface on.
I think, Linda, people have different utility functions. They have different
Back
things.
to the artwork.
They have different utility functions. They have different goals. For example, I'm a trader, and somebody approached us. I'm doing very well. I'm #1 trader in the U.S. in futures, which is not bad for a part-time professor. But somebody approached us, and it's because they have huge losses in this market, and they would like to turn it over to somebody who's winning. And we learned that out. So there's a lot of devious stuff that goes on.
That's right.
So it's very interesting.
That's right.
So they have different information, different goals.
Right.
So you have to do a multi-complicated model.
Right. But in terms of insider information, really technically speaking, we don't have that because we don't have any of those phone calls or smoking guns that we see. That's not what we're testing.
Can I ask the second speaker?
Yeah.
First of all, lovely talk. It was wonderful. Ken Griffin is a very top hedge fund person, and he's able to buy $80 million Picassos and so forth. And he always says the following: for his traders, they have to understand the theory and the methods, and in the end, it's a judgment call. So what I do in my fund, that's what I do. Now, I write a lot of books. We've just finished one on stock market crashes, which I hope you'll enjoy. And I traded all of these that you're talking about except the Italian. Now, in the case of Trump, what I do is I watch what's going on. I hear people. I listen to what they actually say. So, for example, in the night of Trump, it was expected that it would be negative, and we came in. And in fact, the Dow Jones average fell 800 points. So I watched it. Carl Icahn bought $1 billion at the bottom. The minute that Trump started speaking, see, I analyze him as there's two Trumps. There's the guy who insults everybody, fires everybody, and possibly will cause World War III. And then there's a second Trump who has all sorts of nice economic policies, and he can read a careful speech written by somebody else. So during the campaign, lock her up, put her in jail, all this stuff. So I'm sitting there, and all of a sudden, the first words that come out of his mouth were, "Hillary is a great person. I really respect her." I went massively long. I made $300,000 trading futures. Now, I only do two things. I only do the Russell 2000 small cap and the S&P large cap. And I know about Engel's work and others, and it's wonderful what you're doing. I have a sort of a much simpler way of doing it, and it works for me, is I watch the VIX. When the VIX turns, almost always the S&P turns with it, etc. So this happened in the French election. I made $554,000. My God, I have guys who calculate. I don't care about this. All I care about is I win. But I have guys who calculate.
The question? Bill, the question.
And what happened, can I just finish for just a second?
Yeah.
Because I think it's important.
Yeah.
See, what happened in there, and I've got a question for him, actually. I'm not talking about myself so much. trying to understand his measure. In the French, what was very interesting was that there were 5 candidates who would go for Frexit. And the minute that it was clear that Le Pen would not win, it was obvious the market had to fly. So it was obvious. So here's the big question I have for you. Your measure has many good uses, as you've shown. Does it have the ability to change quickly when the information changes? So, for example, during the French election, we had to change very fast when it looked like the person was going to go for a Macron and not for Le Pen. And we had Trump being Trump number 2 instead of number 1, et cetera, et cetera. So the question is, do you have a way of reacting quickly to the news? But now, I'm more involved in trading. You're more involved in giving information.
Exactly.
It's a different goal.
Thank you very much for your very informed question. And I would say that this is not a trading tool. It is a risk tool which tries to measure more long-term effects, and particularly the persistence. So all these measures are not are not meant to be reactive on a real time for trading purpose. It was more to understand the capital level of institutions under a stress scenario over a long term. So this is a long-term risk measures over a 6-time horizon. So to answer your question properly, you focus on risk horizons and also purposes. So we don't focus on short term, it's more of a long term. I would say this can be considered as an evolution of the value at risk measure, which is a classical one-day measure, and Engel extended that to take into account the deficiencies of a VAR measure.
2 more questions. One. Introduce yourself.
Ettore Panetti, Bank of Portugal. 2 remarks very quickly. First, in SRISK, there is no issue, there is no measure whatsoever of financial contagion, of how a bank is interconnected to the others, and I believe that's a bit troublesome, especially because you correctly said that financial crises are often about self-fulfilling runs that spread from one institution to the other. So interconnectedness of a bank in the financial system is really important, and that's not accounted. Second, why the result of the Italian referendum had no effect? To me, the reason is that the referendum was anticipated in the end. If you look at the spread between the Italian bonds and the German bonds, you see that they start increasing in August, exactly when the results of the polls started saying that the no was about to win. So markets anticipated the results, no big effect. On Montepaschi, obviously, there was an issue of the timing of capital injection, which was connected to the result. It was exactly 2 days afterwards or 3 days afterwards. So obviously, there was a result, but not connected directly to the referendum, except for the political issues.
Yeah, no, thanks for these 2 questions. First of all, on the interconnected, I would say that SRISK aims to estimate the effect of a tsunami, of a shock, instead of a contagion. This is true. But the reason is that Rob Engel particularly affirms that statistically, the fact that there is a movement of financial assets at the market and the market index includes already the contagion, because they're assuming a wide stress decrease of the global market. So there is implicitly, contagion is not explicitly modeled, but it's taken into account implicitly because there is an assumption of a 40% decrease of a stock market equity index, and then all of the institutions are going to react. So there is a common factor, right? So there is implicitly, it is much in line, very similar to the construct of the Basel regulatory formula. So there is essentially, in this case, a latent factor, which is the 40% decrease implicitly, even though agree with you, it cannot be explicitly measured. The second question on the Italian referendum, there are different situations, expected, unexpected. We know, I agree with you, so it was largely, I would say largely, it was, maybe the Prime Minister at the time was not expecting that, so I would say like that. But also, I think the situation of Italian banks is not necessarily the referendum that made a difference. The Italian system particularly is affected by the problems of the banks, and there is still an unresolved issues around non-performing loans, exposures, capital requirements. The two are interconnected, and also we know that unfortunately versus the other European peers, NPLs in Italy and capital requirements are also, some of the banks are lagging behind, particularly smaller banks. So I think, let me say that the situation of the country was already not super positive before the referendum, and then it wouldn't be such a trigger. But let's see what happens next. I think the results of yesterday's election are even more important for the future of the country, but also for the future of Europe. It seems to be that again the populist trends are going to play a much smaller role against the future of Europe, I think.
Yes, Raul, but just if you want to be patient on the NPL, on the third day we will have Massimo Marchesi from the European Commission that is responsible for the monitoring and supervising the NPL in Europe. So he will give you fresh information about this. Raul.
Yeah, thank you very much, Oliviero. Since we are in beautiful Firenze, not far away from Siena, another great city, I would like to ask a bit more about your views on Montepaschi di Siena. You mentioned this interesting figure of 8.8 billion euros capital shortage, also based on the systemic risk measure. Yeah. The question now is also, during the past year already, is who is going to pay for it? Who is going to provide this recapitalization? And as you know, there's now this discussion going on that there have been numbers circulating in the press that basically there will be a limited bail-in of 2.2, and there will be a type of bailout by the Italian government of around 6.6. Those are numbers which have been circulating. But this is all based on the fact that Montepaschi di Siena is still a solvent bank. Hey, it's below the regulatory minimum, but it's still feasible, viable, although stress tests have reported negative numbers. My question to you, Cristiano, is when you talk to international analysts, wouldn't it be the case that most analysts on financial markets would say that basically Montepaschi di Siena is not a solvent bank anymore? And that would mean that the precautionary recapitalization as an exemption clause in the Bank Recovery and Resolution Directive should not be applicable, and that we would need a full bail-in combined possibly with the direct recapitalization of the European Stability Mechanism. And why is this so important? Because this is the first big test of the single resolution mechanism, and if Montepaschi di Siena gets away with it in this way, it may affect the credibility of the whole system. And there's a lot of concern in many countries in Europe about this.
Yeah, no, thank you very much, and I think your views are very relevant due to your role as in the system. If you remember correctly, you are still in charge of the Shadow Financial Committee, so I've been working for many years, and I think you're totally right. So this is a test for this new mechanism in Europe. We saw the Banco Portugal intervention by Santander days ago, but also you mentioned Monte dei Paschi. How they're going to sort it out, the situation. I would like to say in Italy there are also situations on other two banks, smaller banks, Popolare Vicenza and Veneto Banca, that is creating lots of issues. The 6 billion, whatever it is. On the Monte dei Paschi, my view is that I agree there should be potentially, so the European Union Commission agreed to another state intervention under some very specific conditions, and some of them are particularly the bank will be still solvent at the time, NPLs will be completely solved. So these assumptions are very strong assumption because are not easy to apply in this country, and also because the NPL market is still far from being functioning. So even selling something, there is a much more important issue in this country about the legal system, the bankruptcy law. So if there are not reforms here, I think bail-in, whatever. My point is that if there are not political reforms behind it, then will be obviously a negative test that can have implications on other countries. I would say it's difficult also to have support from other banks because the Italian system is not, because of the NPLs, highly capitalized. And then again, there is a need to reform the system. You continue having NPLs with zero recovery if you don't reform the bankruptcy law. I think it's all on the recovery rate and on the NPLs is all about more a legal issue than an economic and financial issue. If in the UK you can recover in 3 months, a year, to recover a credit it takes 20 years, then this is why the recovery rate will never be at a decent level. And the more NPLs you have, the more capital you need to have to withstand the requirements by the regulators and also by the market. So let's see what happens. Anyway, we don't have a crystal ball. It's more, I would say, a political issue than an economical story. But at least there is an agreement, an announcement that in July the listed instruments will recommence to trade after the delisting in December. We are positive. It's still unclear to me how these funds, where these funds will come from, and because of the other issues in other banking institutions. But it is an important. These are important tests for the solidity of the mechanism placed in Europe. So it's a new situation, and I hope it's going to be addressed and sorted out properly.